Hi, everyone. I'm Matt Clark, research analyst for Money and Markets, and joining me as he does each and every week is Green Zone Fortunes co-editor Charles Sizemore. It is time for Investing with Charles. Before I get started, though, I do want to remind you that if you have a question about maybe a stock or the broader market or the economy, and you'd like Adam, myself, or Charles to take a look at it, we will be more than happy to do that. You can send your question to our email address, which is feedback@moneyandmarkets.com. We'll put that right down below there. You can also comment below on our YouTube channel as well. If you do submit a question and we use it in any of our videos, we will hook you up with some very cool Money and Markets gear. We've got t-shirts like the one I have on. As I've said before, you don't get the one I'm wearing because I'm actually wearing that one and it's mine. But we do have some that we will send out your way if you submit a question and we use it. Also, check out moneyandmarkets.com. It is your home for safe, sound, smart, simple, profitable investment information for your portfolio. Our entire team, from Adam, Charles, myself, everyone, we all work very hard to give you that information 7 days a week, all at your fingertips. You can use our proprietary stock power rating system as well, create a watch list. You can do all sorts of great stuff, and you can do it all at moneyandmarkets.com for free. Now, today, we're going to talk about something that's kind of been big in headlines of late, especially with the markets going the way it is, and that is bonds. And Charles, we just kind of freelance this one ourselves, and I just want to start off with the basics. First off, what is a bond?
So, Mr. Bond, yes, it's not James Bond, actually, surprisingly.
No.
Anyway, about that. So what is a bond? A bond is essentially an IOU. So a bond is a debt instrument issued by a government, a company, or perhaps a municipality, some entity issues an IOU, and they pay interest on that generally twice a year, generally semi-annually. So let's say you pay $1,000 for a bond, you receive interest payments twice a year. At the end of that bond's life, you get the face value of that bond back. If it's $1,000, you get $1,000 back. It's $10,000, you get $10,000 back. Whatever that face value is, you get that back at the end of the bond's life. Bonds can range they can be anywhere from a couple days to maturity to 30 years, or in some cases even longer. There are rare instances of 100-year bonds. I don't know that I'm that enthusiastic about my health that I expect to cash in on a 100-year bond, but they do exist.
So you've talked about kind of what a bond is. You talked about a little bit about how it works in terms of, you get a regular interest payment, typically semi-annual, then you get the principal back at the expiration of the bond. But I guess another question to kind of lead into is, what's the point? Why buy a bond? What are you doing? Why do that?
What's the point? Yeah, there's really there's two reasons to buy bonds. The first is the income is predictable. If you want income, bonds are the most traditional income instrument. So, that's very simple income. Beyond that, bonds do have the additional benefit of being minimally correlated to stocks. This year is sort of an exception, but generally speaking, stocks and bonds will move different directions. If your bond portfolio if your stock portfolio hits some speed bumps, generally your bonds will be doing well. So they offer diversification. They reduce the overall volatility of your portfolio.
But there are risks, though. What are those?
There's really there are risks let's divide this up between government bonds and non-government bonds. So the U.S. government is not going to default. If the U.S. government defaults, then we have bigger problems in our bond portfolios, right? So, but with anything that's not a U.S. government bond, there is always the risk of default. There is the risk that the borrower just doesn't pay. If you buy high quality bonds, that's a pretty minimal risk, though. That's unless you're buying junk bonds, that's generally not something you have to worry about too much. Now, the worry that you do have, we all have this worry, particularly for longer term bonds, is inflation. So those interest payments you get every 6 months, they don't change. They're the same today, and they're going to be 30 years from now. So they don't keep track. They don't keep pace with inflation. And then beyond that, you get the face value of the bond back. Let's say you buy the bond at par. You buy it for $1,000 today, and you get that $1,000 back in 30 years. Well, in 30 years, that $1,000 isn't going to go as far. So that's really your biggest risk with bonds. It's just that the I word, inflation.
Now, without getting into too much detail, because next week I do want to kind of promo a little bit We'll talk about stocks versus bonds for income, which Charles has kind of touched on a little bit, but we're going to take a deeper dive into that. But what are some better alternatives to bonds that you can use for that kind of, not necessarily residual income, but for that stream of income that you would see with your semi-annual interest payment with a bond?
Yeah, sure. So there's no total substitute for bonds, and that, that combination of income and, portfolio stability, it's hard to mimic that elsewhere, but really a better alternative for most investors most of the time is going to be a dividend paying stock. If you buy a good, safe dividend payer with a long history of paying that dividend, the company is healthy, they're easily covering the dividend, there's no obvious risk of a dividend cut, then you're going to be much more likely to keep pace with inflation, because most healthy companies raise their dividends over time. So that income stream grows every year, every couple of years there, whereas you don't get that with the bond. Furthermore, stocks don't have a terminal value, so to speak, in that that stock is presumed to be perpetual, it lasts forever. So you can sell it next year, you can sell it in 30 years, presumably at a higher price, assuming we're not in the middle of a bear market at the time. You should make money over time as the company grows. You just don't get that with bonds. Another element is, particularly if you're focusing on volatility reduction in a portfolio, just keeping some of those drawdowns to a minimum. Focusing on dividend payers that are also very low vol, particularly on our stock power rating system. If you focus on, companies have a high volatility rating, which would mean they have low volatility, that you can also, kind of recreate a lot of that volatility reduction you get with bonds. Not a perfect substitute, but all things considered, I consider it better for most investors most of the time.
I see. And like I said, next week, we're going to dive a little bit more into stocks versus bonds, strictly on an income comparison. So just kind of, comparing apples to apples, with that apples being income, and how do bonds rate up and how do stocks rate up. We're going to talk about that next week. If you have a question about maybe comparing stocks versus bonds and income, submit that to us. You can submit that to us at feedback@moneyandmarkets.com. We'll put that right down below there. You can also submit your question here on YouTube. If you do submit a question, we use it. Like I said, you will set you up with some very cool money markets gear, like t-shirts. Not this one. I can't reiterate that enough. Someone actually asked, whenever I said that, someone actually asked if they could have the t-shirt I was wearing, and I said, no, I'm not really sure why you'd want the t-shirt I'm wearing, but no, you can't have it. But we do have t-shirts.
They wanted to frame it and put it on the wall, man. Come on.
I guess. I don't know. They only asked for the shirt, not for anything else. So I'm not really sure where to go with that. But alas, we digress. And also check out moneymarkets.com. It is your home for safe, sound, smart, simple, profitable investment information for your portfolio. You can check out our proprietary stock power rating system. We give you the metrics of thousands of stocks. We rate stocks on 6 metrics: 3 price-based, 3 fundamental-based. You can check all that out. Just go to the top right-hand corner of the website, of the homepage of the website, moneymarkets.com. Type in any ticker, and you will see the rating of its stock based on our metrics. You'll also see a stock chart, fundamental data, anything we've written, any analysis we have on that stock, and it's all yours for free. Also, at some point in time, we'll be able to have you sign up for our Stock Power Daily email. That is an email where I give you one pick per day that rates high in our stock power rating system, and we send it out. If you have it, great. If you don't, we're working on getting signed up so that you can get it, and we'll have that for you at moneymarkets.com. Charles, any parting shots as we head into the holiday weekend?
No, I'd say, the volatility we've had this year is an interesting case study in what can go right with bonds and what can go wrong with bonds. It's shorter term bonds held up pretty well. Longer term bonds actually got beaten up pretty bad due to the high inflation. So it's sort of a real-time lesson here. and we're getting more and more of those every day as the market whipsaws on a constant basis. So the lessons learned are probably still on the horizon as well, or there's more coming. So certainly hope everyone enjoys the holiday weekend. It is the 4th of July holiday, so hope everyone enjoys that. He is Charles Sizemore. He is the co-editor of Green Zone Fortunes. I am Matt Clark. I am the research analyst for Money and Markets. Until next time, everyone, safe trading.